Hi, my name's Phil Greenwood, and I'm a professor at the University of Wisconsin School of Business and teach courses in entrepreneurship, strategy, and finance, both for the MBA, undergrad, and executive MBA, executive education departments within the school. In addition to that, I have a number of years in industry, both as a CPA, a auditor, and as a strategist, and as also a consultant to small business. And today we're doing our first in a series of finance and accounting podcasts, which we're going to call the Craft Beer Finance Program, which are financial concepts aimed at the owners and managers of craft beer to provide them with some insight and background in an understanding of finance and accounting, especially in this growing industry of craft beverage and craft beer. This first series, what we want to talk about in our short podcast is just providing a little bit of background on balance sheet and income statements, the two key financial statements for a craft brewer or any type of small business. We just want to provide a little bit of background, and then we'll provide some examples of income statement and balance sheet and utilize these examples throughout as we get into more analytical stages of our podcasts. The balance sheet is a critical statement produced at the end of each month, end of each year, that provides an idea of the financial condition of the craft brewer. What it does is it shows the assets of the company as a particular day. In other words, what's owned by the company, the cash, receivables, inventory, and such. We'll show an example in a second. But they also show the obligations of the organization, or what we call the liabilities. In other words, the accounts payable, the amount owed to employees, any bank loans where the principal is owed, or any interest, and then flows into what we call the shareholders' equity account. In other words, if we have the total assets, the value of what we own in the company, subtract out what's owed, this is the balance of what's left over for the shareholders or the owners of the organization. It also gives you somewhat of a rough value, or what we call the book value, of the equity in the firm. Two things to note about the balance sheet before we get to the example is it's kind of a snapshot as to what takes place, what the condition is as of a day and time, not over a year or a month or a quarter, but that particular day. And also an equation holds that's, we call it the accountant's equation, where total assets must equal the liabilities and equity in the firm. So, in other words, the assets that we owe are financed by the obligations and the equity owned by shareholders. Here's a very simple but effective little illustration of a craft brewer balance sheet, and we'll use this throughout our podcast as illustrations for ratio analysis and such. In this particular example, you see the balance sheet shows several key asset accounts: cash, receivables, inventory, fixed assets. They also show the liabilities and equity, in this case, short-term debt. In other words, the amount owed to the bank that we have to pay off within the next year, accounts payable owed to our vendors, or potentially amounts owed in the form of salaries and things to our employees. Any long-term debt, which could include things like a bank loan, but the principal that we'll pay in later beyond the current year. And then finally, the equity, what's left over for the shareholders. As you can see, it presents two different years, so it ends up presenting the financial condition of the company at the end of 2013 and 2014. And also it shows a third column, which shows the increase or decrease of each account from year to year. Notice that the assets equal liability and equity, and notice that the change of the increase in total assets equals the change or the increase in total liabilities and equity. Why it's important to understand the increases or decreases in the accounts will come in handy when we start talking about the cash flow of the company. Couple things to note. Financial statements, and specifically the balance sheet, are calculated in the United States under what we call generally accepted accounting principles. In other words, GAAP. GAAP, GAAP, are policies and standards set about by the accounting profession that provide rules and policies on how to account for all these different categories of assets, liabilities, and equity. Key things are done this way so that so that everybody tries to calculate their balance sheet and their income statement under the same format. In the case of the balance sheet, you'll notice things that like the assets are listed from the most liquid, being cash, to the least liquid, in other words, fixed assets. When we say liquidity, it means the ability to convert something into cash. A couple other things to note is assets or liabilities will have a category where they'll split the assets or liability into either current or non-current items. Current assets, for instance, are assets that we expect to be converted into cash within the next year's time. Any non-current assets are those assets that will be on the books a year or greater than a year's or longer time from now. Same thing with liabilities. Current liabilities are obligations we have to pay off within the next 12 months, or long-term liabilities are stuff that will be around longer than the year's time. The income statement is a statement that follows the revenues and expenditures or the economic resources of the firm over a period of time. In other words, an income statement might be for a month, might be for a quarter. In this case, the example we'll look at, it'll be the revenues and expenditures for a whole year. Generally, income statements are broken down into revenues and expenditures. Revenues also called sales, but can also include things like royalties. And expenses, which can be cost of goods sold, the cost of the inventory being sold and manufactured, can include marketing expenses and so on. Subtracting the expenses from the revenues will give us our profit or loss, and there'll be several categories of profit or loss that we'll want to look at. And also be aware that accountants and financial people use a number of acronyms or abbreviations when discussing especially income statement items as they present them or talk about them with business owners, bankers, and such. In our company's example, you'll see we have an income statement for 2014. This will be the operating results for the entire year during 2014. Sales, which in this case might be craft brew sales for the 12 months, were 1,000. This company might have rounded off the last 3 zeros. We don't know that for sure. And then it has, subtracting from the sales, operating expenses. In this category, which we don't break out into detail, it could include marketing, salaries, rent, depreciation, also the cost of goods sold. In other words, what was the cost of the inventory that we're selling off? And in this total amount, we subtract it to get to our EBIT, or earnings before interest and taxes. Many times you might hear financial people refer to this as EBIT. This is a key number because it looks at the profits before we have to pay interest to the bank or on our loans, and also before we pay taxes. It's a better indicator of how well our operations are generating profits. Couple things to note. In the income statement, in this case, this is not the cash flow of the business. In other words, just because we have earnings before interest and taxes of $240 doesn't necessarily mean that the cash that we generated is equal to that amount. There may be certain things like in sales, in the case of this income statement, were recorded, don't necessarily represent cash receipts, but represent the revenue of when we actually shipped the product. So we look down, we subtract from EBIT or EBIT the interest expense. That gives us our earnings before taxes, what we have to pay the government. Then we have our income tax expense, which in this case typically will include both federal and state income tax. That gets us down to our profits after tax, or in other situations, people might call it net earnings or net profits or net income. We take out of that amount the $50,000 or $50 that they're going to be paid out as dividends to the owners, and that leaves us with $50 that represents the amount we call addition to retained earnings. In other words, that's going to be the amount of money we keep in the business, which will then flow back through to the balance sheet. Interesting to note is that the balance sheet and income statement are interrelated. In other words, we have to reconcile the two. As we said, the net profits or earning after taxes, we take out dividends. This will represent the increase or decrease to the shareholders' equity for each year from year to year on the balance sheet. Now, when we look at the change in shareholders' equity or owner's equity, or in our more simple example, the equity account, typically the change will be earnings or losses after taxes, take out dividends, increase equity by selling any new stock, and also subtracting or reducing equity sometimes when companies actually buy back stock, or what we call treasury stock. Remember, in the company's balance sheet example, the equity account increased by 50 from year to year under the column change from 2013. Well, that 50 represented the earnings after tax of 100, subtracted by 50 of dividends paid to the owners. So in other words, we're able to say that equity increased by 50, and we can explain why it happened. We were basically able to retain 50% of our profits after tax in the business.